And we are live.
All right. Good morning, ladies and gentlemen. I call this hearing to order and acknowledge that we're in Treaty 1 territory, the home and the traditional lands of the Ojibwe, the Cree, the Dakota peoples, and in the national homeland of the Red River Métis. Our drinking water comes from Shoal Lake 40 First Nation in Treaty 3 territory. My name is Ron Merritt. I'll be your chairperson this morning. Introduced in the panel members via Zoom is Michelle Duncan and Mr. Bill Moratsky. Our recording secretary is Nicole Carnegie, and representing the city from the assessment department is Victoria Ho. This morning we'll be hearing application for revision of the assessment roll according to the Municipal Assessment Act. The matters for which revision is requested has been described in each application, and we'll limit discussions to those matters. The statements that are made at the hearing are sworn testimony, and anybody speaking in these matters must be sworn in. Please be advised that comparisons of assessments of properties are not considered evidence of market value by the Board of Revision. The Board of Revision is appointed by City Council and is independent of it, along with the City Administration. We make our decisions based on the evidence provided at this hearing and issue a written order that will be mailed to all parties as soon as possible. Please note that the Board of Revision decision is in respect to application may be appealed to the Manitoba Municipal Board if the matter pertains to assessed value or classification, or to Court of King's Bench if the matter pertains to application from exemption from taxation. Should you wish to appeal, information on how to do so will be included in the board's order. In respect to the hearing this morning, I will confirm the points of appeal with your property to be addressed with each applicant following the swearing in. We'll then have the assessor's testimony, followed by questions that the applicant may have. Then it'll be the applicant's testimony, followed by questions. Each party will have the opportunity to summarize if they wish. Once all evidence about the application has been brought forward, the applicant may leave. The process will repeat for each item on the docket this morning. The session will close after all applications have been heard, and the board will deliberate in private and make its decisions. You'll receive the board's decision by registered mail as soon as possible. As information, all public hearings are live stream recorded and will be part of the public record. This morning, we have items 1 to 6 on our docket. So, Ms. Carnegie, I'll have you affirm the assessor and swear in the applicant's testimony.
Thank you. Madam Assessor, please state your full name.
Victoria Ho.
Do you affirm that the evidence you are about to give at this hearing is the truth, the whole truth, and nothing but the truth?
I do.
Mr. Neufeld, please state your full name.
Rocky Neufeld.
Do you affirm that the evidence you are about to give at this hearing is the truth, the whole truth, and nothing but the truth?
Yes, I do.
Mr. Mercury, please state your full name.
James Mercury.
Do you affirm that the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
I do.
Thank you.
Mr. Neufeld, I can read your mind, so you want to go to item number 5 and deal with the non-co-op?
Oh, if you could read my mind, that would be troubling, and because you know many other things.
Well, it's Monday.
Okay, yes, that's a good idea.
All right. Okay, so we'll go to 173 Marion Street. Ms. Ho, you can take us through this property till you get to the non-co-op issue, okay?
Alrighty.
The floor is yours.
Alrighty, so file number 22-3262, roll number 0609080810, address is 173 Marion Street. Under appeal is the assessed value of $1,113,000 for the reference date of April 1st, 2021, for the roll year of 2023. We have this assessed as under parcel use of as a commercial retail store. We have the overall leasable area as 4,747 747 square feet. I have a request for the burden of proof to be placed on the applicant for non-cooperation under Section 53B of the Municipal Assessment Act, and if a reduction in the assessment is ordered, that it follows Section 54 3.2 of the Municipal Assessment Act.
Thank you, Ms. Ho.
Mhm.
I think we can stop you right there.
Yep.
All right. Mr. Newfield, Mr. Mercury, your evidence and your presentation for the non-co-op.
Yes, typically we would ask some questions, but I think they'd be self-evident here. The position here is fairly straightforward and very similar to previous presentations which you've heard. If you look at page 11 of the assessor's brief, the first thing to note is the mailer itself has not been included in the material, so we don't know where it was addressed or to whose attention it may have been made. Page 11 is the Canada Post report. You'll note that there is no indication. There's signatory name is blank, and then at the bottom it says signature unavailable or not requested. So although there is a note indicating June 10th it's delivered, like several other non-co-op requests we've seen from the assessment department, that in itself does not show where it was delivered, who received it, whether they had authority to receive it, and so forth. So in light of that, very clearly the assessor has not established the non-cooperation. We've included in our rebuttal material the same cases which you will have seen previously. I don't know if that has been distributed, but perhaps it should be.
It has been distributed.
Okay, thank you. So I won't take you through. I think all of the panel members here have heard our presentation on that. Just very briefly, there's 2 or 3 municipal board orders, all of which make it very clear that there must be evidence, proof of receipt by the owner or someone with authority to receive the documentation. That clearly is lacking here. And simply evidence of having put it in the mail is not proof of service. We have included copies of previous Board of Revision orders from this cycle, where very similar evidence has been put in by the assessment department. All of those cases, the request for penalty was denied. In fact, I think we had a voluntary withdrawal last week or the week before with very similar evidence from the assessment department. So in light of that, our submission is that this is not a case for a deferral order, and of course, we're subject to any questions. Thank you.
I thank you. Ms. Ho, any questions of Mr. Mercury?
No questions.
Okay, I thank you. Ms. Duncan, any questions of the non-co-op issue with Mr. Mercury?
No questions.
Okay. Mr. Ratsky?
No questions.
All right. Madam Secretary, we're going to shut it down just briefly so we can draw our conclusion. All right. We'll call the hearing back to order. The panel has unanimously, with the non-co-op issue, denied it. So that concludes that part. Mr. Mercury, you're free to go. I think this was your only part, was it not, Mr. Mercury?
Yes, I believe that's correct. Thank you.
All right. So thank you for your attendance and presentation. And have a good day.
Thank you. You too.
Mr. Newfield, do you want to go back to number 1, or do you want to proceed with this one?
No preference, your call.
No, whatever you prefer. You want to go back to 1?
It's fine. I don't even have an order in front of me, so it doesn't matter to me.
Ms. Ho, what do you think?
We'll go with 173 Marion, number 5. I already have it up.
All right. All right, give us a chance, and so we'll go to 173 Marion Street, and the non-co-op issue has been denied. So, Ms. Ho, the floor is yours.
Lovely. Alrighty, so if you can see on my page 3 of my brief, there is a subject sale for the property registered October 4th, 2021, post reference for $1,180,000. If we continue on to page 4, we have some rent comparables.
Ms.
Yes.
Ho, can I interrupt you?
Yep.
That should not be, included in the presentation. So
Sorry.
I'm sure Mr. Newfield is going to ask that it be deleted.
Yeah, not a problem. That was,
Right.
I just realized that it was post-reference. That was my
Okay.
bad. Yep.
Okay.
Let's go to page 4. We have some rent comparables located close to the subject property around St. Boniface, ranging between $15 to $22. These are not they're not super recent leases. They're close. Probably the most recent one would be 196 Taché Avenue. The lease start date is July 2020 at around $15 square foot. However, other leases do seem to indicate commanding market commands a little bit higher than $15, as demonstrated in this table. Page 5 is the income stream workup for the property. This is all model generated, and we're looking at rent per square triple net per square feet as low as slightly above $18 up to $19.37. If we continue on my page 7, we have a cap rate chart. If we can take a look at the retail section, there is no cap rate for a retail store. However, a lot of the cap rates have been indicating closer to 6 to 7.2 for cap rates, according to the city of Winnipeg. According to City of Winnipeg, Colliers is indicating between 6 to 6.75. CBRE is considering between 5.75 to 7.5. Cushman and Wakefield is considering between 7.75 to 7.25 for their cap rates for retail. So just indicate that a blanket overall that there is a stronger indication of lower cap rates in the market. Page 9, you can see there is the picture of the subject property at the corner of Marion and Kenny Street. And there's more pictures of the subject property on page 10. Page 13 is the old income and expense mailers that have been responded to. And that is all for my presentation for this property.
I thank you. Mr. Newfield, questions of the assessor?
Yes. Your page 5 5 valuation, is this all done by the model?
Yes, it is all done by the model.
And the comparables selected on page 4, did you select these?
Yes, I selected them.
Do your comparables have parking?
Not too sure. They're all along on Provence and Taché and Marion. So I'm pretty sure parking is pretty limited, but I'm not too sure if it's the same as the subject property.
Well, you're not aware that, for example, 131 Provence, that they bought a parking lot for their building?
I am not aware.
Okay, does the subject have parking?
It does not appear to be, except according to looking at the pictures.
Would that have an impact on potential rent?
Yes, it most likely would.
I noticed the other thing about your comparables. These were all written at least a year before COVID, were they not? Except for 196 Taché?
Yes.
And 196 Taché actually happens to be considerably lower than the other pre-COVID rents. Did this not have was this not a concern for you?
Yes, it is a concern for me. But however, there were limited comparables I could find. There subject lease, limited leases in the immediate vicinity. There is also 131 Provence, unit 113, that also leased in August 1st, 2019 during COVID for 2,000 square feet at $19 a square foot. So there's pretty much only two more relevant leases during COVID, if we're talking about COVID, pertaining to our rental rates.
Sorry, I'm just going to correct you here. I'm just reading something. The World Health Organization only identified COVID December 31st, 2019.
Yeah. Oh, sorry. My bad.
Okay, so let's just make sure. You had the one rent at $14.99, and the rest were all before the impact.
But I am very not caffeinated right now. I'm sorry.
Okay, well, no, that's fair. I was a little surprised because I was thinking, what was I doing?
I'm sorry.
I thought it was 2020.
No, just need coffee.
Okay, wait, there's something else here. The model workup has potential rent at roughly $89,000. I'm looking at your page 13, and although this was a year prior, it looks to me like 67,000 was potential rent. Wouldn't you have thought that maybe the actual rent should have be a stronger indicator of value than the model's rent?
Which page?
Page 13. And what I did is you see 48,000, but then they had interest. So I just changed it at 67,000 is the potential income. And that's full. That's potential.
They're also including property taxes into the expenses too.
Right, because it's a gross lease building.
I thought it's owner occupied, fully owner occupied.
I did not hear that in your testimony. And who's the owner?
I'm not too sure. It says property owner is the Go Corp.
Yeah, that stands for Theo. Forgot her last name. She owns First Fire something. Their office is on First 280 Stradbrook. Theo Heinemann.
Okay.
None of those are her.
Okay. Okay, so we're looking at a potential, like an overall income of a revenue of $102,231, and if these are all triple net rents,
No, if you do the math on page
Mhm.
15, you'll note
Yep.
that what they've done is calculated the monthly rents and added in the recoveries. So they have income, including recoveries, of 102,000. There's nothing wrong with this statement.
okay.
So just based on that, did you not think that those might be a good, better indicator?
Most likely. Again, the model is generating based off of not just from the actual lease of subject properties, but however, given that we don't have the actual response for the INEs for the 2020 year, we're not able to see how much COVID impacted this property in particular. So
Well, it's good.
the model is deriving information from across the city. Well, not just across the city, but whatever information it's available.
Are you suggesting that income from 2020, before 2020, at 67,000 potential, would actually increase during COVID?
No, I'm not indicating that. I'm just saying it would be a lot nicer if there was more information
Sure.
from the owner.
Thank you. Those are questions.
Yeah.
I thank you. Ms. Duncan?
Just in that same mailer on page 13, the owner occupied box is checked off.
Yeah.
That would indicate it would be owner occupied then?
Typically, yes.
Okay.
But according to the applicant, none of the units are occupied by the owner.
Yeah, so I mean, I guess the accuracy of the mailer overall is my question then, and it looks like there's one missing for the last cycle. So yeah, okay, good enough. Thank you.
Thank you.
Thank you. Bill, questions?
Okay, so it is fully occupied then? Is that what you're saying?
I'm not. I'm just presenting whatever information is available. It's our income and expense mailer. It was answered by the property owner, and it says that it's owner occupied. However, it does say on page 15 that it doesn't indicate that any of these units are occupied by the owner.
So it's fully contradictory information from page 13 to 15 in your opinion?
Yep. Yes.
So we don't know which one is correct. Any more than you do. Well, is your best guess that it is rented out then? That'd be your best guess?
I can assume so, yes.
So the page 13 is more likely an error then?
Most likely.
We'll go back to page 13 and you had your discussion about the allowable expenses. In your opinion, we should be adding in or should not be taking those property taxes off. Is that what you said?
Pardon?
In your discussions with Mr. Neufeld about the expenses on page 13,
Yes.
he was talking about the property, or you mentioned the property taxes, that they should not be included in those expenses. Is that what you said?
Yes, but however, Mr. Neufeld indicated that that the total income has already included the recoveries. So the only thing that we shouldn't be including in the in the expenses is the interest.
Okay, so then he was correct when he said 67,000.
At the moment, I haven't really done the overall calculation, so I'm going to assume what he's indicating is correct.
Well, yeah, I mean, the calculation is, pretty simple, right? You just add the interest to the net operating income that's there right now.
Mm-hmm. Yep.
So it would be around 67,000 then, somewhere around there, 68,000.
Yep.
Okay, so your model is showing a net operating income of 79,000. So that's fair percentage higher than what the actual is.
Yes, I agree.
Okay. So what do you think would constitute that difference? Why is the actual
I'm actually redoing the calculation just based off of the monthly rent, based off of page 15, just multiplying the monthly rents of just the 4 units that are listed. I got a total of 96,507.60. That's before recoveries.
okay? And what does that mean then?
So it means that if you look at my page 5, so just to repeat, so all I did was multiply the monthly rents of just each unit by 12, just to get the annual income.
Okay.
So first unit is 17,280, second unit is 20,160, third unit is 39,736.20. Fourth unit is 19,331.40, for a full total of 96,507.60. So that's the overall actual rent for all the 4 units. So if you compare it to the potential rent, our potential rent is 88,891, which is lower than the actual rent.
Okay. Okay. No further questions?
I thank you. Mr. Newfield, your presentation.
Yes, thank you. So just to clarify a couple things here, the concept of owner occupancy, the owner's first life, I should say. They used to be in this building, and in 2016 they were the large tenant. Then they moved to their other site at 280 Stradbrook, and this has been a rental unit since. As far as filling out of the forms, I wouldn't necessarily say that they're doing the best possible filling out of forms, and they've been doing them themselves. You saw the assessor's statement from 2020. I'm looking at another one from 2018, and the NOI was $18,100. What we did is to try to stabilize this is looked at the post-reference number. Now that's on page 3. Now let me just clarify post-reference. Post-reference in terms of when this was prepared. But you'll note that the leases all start October 1st, 2021. So that was the date of management takeover, not necessarily the date when the tenant moved in. And that's why this is good, because then you can then take and compare it to the previous handwritten statements and look at what the NOIs are, or say what the net incomes really were, because now we have a professional manager writing it up. So we're just clarifying the statement. And our read on it was that the net income is $72,000 and that's $690. I mean, it frequently happens when you don't have a professional managing it. The owner, Theo, she sells fire and safety equipment. She's not an accountant. Or people who work for her fill out these forms are doing the clerical work for a fire safety organization. So just have to bear that in mind. But look, if you're looking for accuracy for small business, you have to be somewhat open-minded to the problems they have. So that's why we like the statement when they finally handed it over to professional manager. So even though the previous one it comes in at 67,000, we're pretty sure that it's 72,000 is the number we should be looking at after a pro looked at it. From that, we looked at vacancy and St. Boniface. One of the issues you're going to always hear from me is that if you go with actuals, you must stick with actuals. The assessor's got a 6% vacancy loss. Well, Johnson report did not report that in St. Boniface. It said it was a good performing area. This is a mix of retail and office. So we're at 4.1%, which is lower than the assessor. We do insist on non-recoverables because the statements indicate a fair amount of non-recoverables, and the 2018, as I mentioned, had a 20% vacancy, which would generate a lot of non-recoverables. It is a factor in all revenue-producing properties. Follow the money. There is always non-recoverables. They don't occur every year. And next is shortfall. Again, we're looking at the actuals. Major impact on shortfall is the cost of taxes. Taxes alone are $551 a square foot. Assessors at $7. Our estimate of the actual is $861. When essentially though, we have about $9,000 in costs, and the assessor has about $9,000 in costs. So although we came at it from a different approach, our non-recoverables are very, very similar. The issue at stake is, and the cap rate, I'm not going to argue 7.1 versus 7.25 because I'm not good enough.
Excuse me.
What is seriously wrong here is the rent. 72,000, not 89,000. And that's my presentation.
Thank you, Mr. Neufeld. Ms. Ho, questions of Mr. Neufeld?
Sorry. Where did you get the vacancy? 4.1%.
We rely on the Johnson report. I'll just take a look at it here. Retail.
Okay. I'm looking at page 6. St. Boniface for 2021 was 3.5.
Right.
Okay.
So what we do is okay, let's say St. Boniface, right. And then we look at the overall at 4.7 and just take the mean.
Okay.
It's just a method of trying to make sure that we don't use too small a sample area. So, for example, St. Boniface is 1.1 million square feet of inventory, and the city inventory is 23 million. So it's a little bit of a smaller sample size. So the city help stabilize it.
Okay. Thank you for clarifying. That's all my questions.
I thank you. Ms. Duncan?
Are all 4 areas units rented then, leased?
Yes, they are. They're all leased. They've had some turnover, and I was just trying to read it. I think the last turnover they had was the one that the assessor's brief has marked. MTAM. I think the yoga is still there. There's occasional turnover, but I haven't seen any major turnover in the 3 for between the 20 and the 22 statements.
Okay, so are they longer term leases now, or?
Well, the yoga's a month to month, and the other 3, I don't have a term specified, and I'm just trying to, if you really hard to read here. Massage Therapy Association is on, appears to be, well, it's got some steps in it, steps to 2024. So that's done, not a start in 21. That's when the manager took over. So that would have been, as indicated in the assessor's page, start of October of 17, running to, looks like August of 24. I can't, Tiffany, no, that's, they've been in there.
You know what, that's okay, Rocky. I just see your cap rates are pretty close anyway, so I mean,
it's just income.
Yeah.
Really.
That's good, thank you. No more other questions.
I thank you. Mr. Boretsky?
Okay, so you have the net income of 72,690, and you said you got that from the I can't read any information on page 3 there. Is that where you got that from?
Yeah, that's correct.
So
if you look at the bottom of page 3, the base rent, 6,117 times 12 is going to be 73,404.
this is for what year?
Okay, this is for the leases that were started on the assessor's page 15. You see the lease starts there in 2017 and 18, and these were.
Oh wait, which page 15 on which presentation?
The assessor.
Okay.
These are the start dates, and as I mentioned, the rent roll produced here was after a property manager took over and put it down nice and neatly for us, and that would have been in October. Those weren't the start dates. That's just when they entered it into their system.
Okay, so the assessor had mentioned that these totals on her page 15 added up to 96,000. You have 72,000. So what makes up that 24,000 discrepancy?
Well, I think what we're looking at here is how do I say it? It's an amateur-based management report for the city. You can see that, as I mentioned, that they have a lot of errors in here. Like, is it owner occupied? No, it's not. But they mark it as owner occupied. Is it net? They mark net here, and then you go down to the other form, and they don't mark owner occupied. I know this. I've been reading through their statements, historical statements, and the number is the 72,000 is the most reliable number. going back the previous year. Okay, now if I go back to 2016, it was fully owner occupied. So they obviously vacated in 2016 and put it up for rent, filled it with these 4 tenants. I know they've had 1 turnover in 1 unit, and the most reliable is the statement done by the professional at the 73,000. Previous year, I should mention, 18, I was talking about the net of 18,000. Well, in that year, they listed rent income at 63,718, and then they called it gross. I think we're dealing with, obviously not a professional real estate management person who wrote up these forms.
On page 15 of the June 20 on top there.
See, because the 96,000 still doesn't equate to the 102,000 listed on the income page. So it doesn't match.
That it's a lot closer than 72,000, correct?
Well, close isn't what we're looking for. We're looking for accurate, and accurate was the one done by the professional at 73,000.
Okay, no further questions. Thank you.
I thank you. Summation, either party?
No summation. No summation.
Thank you. Mr. Newfield?
Yes, I'm fully confident that the 73,000 potential income is accurate and reliable after review of it. And I believe that actual income is something we must address seriously. I do. And everyone it was impacted by upheavals in the last 2 years. Thinks that that's far more accurate than a model. Thank you.
I thank you. Let's go to the top of the docket, and we're going to go to 1846 Portage Avenue. Ms. Ho, the floor is yours.
Thank you. So file number 22-3865. We're looking at roll number 0702009100. Address is 1846 Portage Avenue. Assessed under dispute is the assessed value of $934,000 2021 for the roll year of 2023. We have it under the parcel use code neighborhood shopping center. We have the leasable area as 5,680 square feet. And if we can jump ahead and continue on, we have onto my page 4. We have some rent comparables of properties of businesses in the area, renting between $13 to $16 a square foot. Probably our most relevant, most recent rent would be 1853 Portage Avenue on lease start date of March 2020 at $15.50 at a lease. At $15.50. That we have unit 1853A Portage Avenue, which is lease start date April 1st, 2019, and 1700 Ness, lease start date of July 2019. And those are $14.25 and $16 a square foot. If you continue to my page 5, this is a workup from the model for the property, developing to a final value of 962,000. And if you continue on, skipping to page 9, we can see an aerial photo and a street view of the subject property. And from page 10 onwards is the response from the and that is all of that's for my presentation for today.
So you concluded value, and what you have on the assessed value is 934, but you concluded 962. So
oh, sorry.
What is it?
Sorry, it's the assessed value is 934,000. The workup is showing 962,000. I guess there may have been an update done in the system to increase the value to 962,000. But the value under dispute is 934,000.
Mm-hmm. All right. I thank you. Mr. Newfield, questions?
Yes. Was this workup all done by the model?
Yes, it was done by the model.
And in the previous appeal, we had a building built in 1979 with a 7.1% cap rate. This one, built in two stages of 1958 and 1978, both older, is a lower cap rate. Should that be the case?
Sorry, can you repeat that again?
Well, it's got a lower cap rate than the last building, and it's older. Substantially older, half of it.
It may have been because it's the parcel use. I think that because it's because of the parcel use code that it has, and it might be also contributed to where it's located. I'm of the opinion this property should be warranted a further review. I don't think it should be used as have a parcel use code of neighborhood shopping center. Probably.
Yeah. Okay. I see what you're saying. Yeah.
So that may attribute to its lower cap rate.
Okay. And for this is like old times for us. Do you see who the owner is? Five Qs.
Yep.
So you realize that stands for Quinton's, and this was a former dry cleaning location. And in 1958, yes, they did use trichloroethanol. Was there any consideration given for the concerns for detrimental conditions?
There was no consideration for detrimental conditions. No, I was not aware that there was dry cleaning on the site.
No, I'm just looking through this the environmental database as we speak, but it's really hard to find something. But I have looked at this in the past, and there is a registration on this property. Given that, is it fair to say the model doesn't take that into account?
The model does have you can add. There's a way to add a condition for detrimental conditions. I'm not too sure if it's taking an effect for the detrimental condition, if there is for this property.
At 6.3%, it's
yeah,
I think,
probably not.
Probably not. Okay, good. Thank you. And last question, your potential is 67,000. The owner's indicating, looks to be about 59,000. Just wondering if perhaps the model may be overshooting this because, as you mentioned, you're calling it a strip mall rather than whatever miscellaneous retail.
Correct.
Okay, thank you. Those are my questions.
Thank you. Ms. Duncan?
No questions, thank you.
I thank you. Mr. Boretsky?
Yeah, just, I might have missed something earlier, about your value. So the value that you're seeking is 934?
Yes, I'm asking to confirm at 934.
Okay, so would the cap rate remain 6.3 as you had before?
Yes.
And your net operating income is 60,630?
Yes.
So the math will not work out there then, right?
No, the math is not working out. There may have been an update between the time that the appeal happened and when we maybe we were licensing in the tenant. There may have been an update to the property which increased the value. It may have affected when the property was updated. It was probably either the rent or the vacancy or the expenses. Well, not the expenses. It may have affected the cap rate or the leasable area. So I don't know where the discrepancy in value may have happened.
Okay. Thank you.
I thank you. Mr. Newfield, your presentation.
Thank you. I think you've probably figured it out, what I'm going to say. Actual income. The assessor is pretty straightforward. It was probably coded wrong. And this is an old 1958 street front retail with a bit more modern strip attached at a future time period. The older portion, you can see in the rent rolls, is just getting a lower rent than the newer portion, and that's the way it is. This has been on the market for years, and it's been exposed long enough, at enough turnover to trust that the actual income is right. Now, there's a slight error here in the vacancy rate, in that the wrong rate for St. James was selected. If you'll notice below, we have retail 4.7. That's Winnipeg. St. James 9.9. That should actually have been 6.0. And I want to stick with actuals all the time. So I'm going to make a small adjustment to the NOI upwards, because it should be a rate of about, rather than 7.3, about 10.4. But again, non-recoverables, you'll note the statement, they exist. They happen all the time. The shortfall is calculated as before, heavily skewed by taxes. But in this case, the assessed shortfall being based on a strip mall is $9 a square foot. Miscellaneous retail, we're at $7.41. I'm sure that if they changed their use code, the rents would go down, shortfall would go down, and the cap would go up, and we'd be fairly close, I think. So my adjusted NOI is 47,323, and that's by adjusting the vacancy downwards to 5.4. 47,323. Not changing the cap whatsoever. So my adjusted value is 630,976, rounded to 631,000. In regard to the cap, The issues, of course, you've heard it, but the parking stall count is on the low side for retail. You would need roughly 23, and it has 14. Puts a downward impact on your ability to attract tenants. Year built is actually incorrect here. We put 78. It's 58 and 78, and we've been in the place. Quality and condition on the old portion is low. It's generally been just a kind of at industrial level almost for finish, and the other side is better finish, but it's got to be looked at as a whole. And then the last issue is it is on the environmental list. There was dry cleaning done on site in 1958. I don't know. I think it was a Perth's back then. I can't remember. But until about 12 years ago, they had a satellite location on site where and they'd stopped using chemical in the 80s. But in 1958, now it's not a major impact on value. It's not, it's not. We're not going to say it's so contaminated and it's problematic. It should be a huge difference in the cap, but it's the nuisance value of having an environmental impact that's aware on your site. You sell a property, you go to the bank or you go to the vendor or the purchaser, and they want to see, first they want to see your phase one, which is basically a file search. You're going to check and see who was in there before. Earth lights up. That means we go right to phase two, which means sampling. $20,000-$30,000 to every time you do a transaction, because everybody wants to see a new report, and then it raises the uncertainty level. So that's why we think the 7.5. I wasn't complaining about the last property where the assessor was at 7.1. If that's a 7.1, this has got to be a 7.5, and with the actual income. And I'm stressing again, the actual income is primary. Thank you. That's my presentation.
Thank you, Mr. Newfield. Ms. Ho, questions of Mr. Newfield?
No question.
Thank you. Ms. Duncan?
Just to clarify, so the rent of $10.50 a square foot for the entire square footage is actual versus stabilized?
Yeah, it's if you go to page 3, the two sections have different rents. So the Delco wastewater is $977, and I don't know what a Hyena Social Club is, but it's at for $15.
So $10.50 is the average of that, is it? Or
yeah, it's we're just looking at the reported income of $59,496 on page 3, and in this case, I don't do models. I don't estimate it. When there's a discrepancy, I go back to ownership. So in this, the last case, I'm telling you, I talked to the owner and I knew these statements weren't good. This case, we talked to Bonnie. I'm going to drop names here because that's what we do. We go back and we verify things. We don't just guess. And we've known their accounting. I think in 10, 12 years ago, we worked with them to help with these forms, make sure that the assessor got accurate information, and they do a good job. That's my presentation. Oh, sorry. I must say that.
that's your answer.
That's my answer.
Thank you.
All right. I thank you. Bill, questions of Mr. Newfield?
I do not, thank you.
All right. Summation on either party?
We're good.
No, thank you.
We're good.
Okay. We'll go to 2533 Portage Avenue. Ms. Ho, whenever you're ready.
Alrighty, we're looking at file number 22-3294. This is for roll number 075691364555, address 2533 Portage Avenue. Value under dispute is $9,727,000 for the reference date of April 1st, 2021 for the roll year of 2023. We have the parcel use code of commercial neighborhood shopping center. We have a total, I guess, a number of 3 buildings. They're all 1 story. The actual year built is 1958 to 2003. We have the overall effective year built is 2006. We have the total leasable area at 33,146 square feet. And if you skip to my page 3, we can see that there's a registered sale on November 10th, 2015 for sale and consideration and sale price of $10,925,000. We continue to my page 4, and I think it's just my page 4 that have a list of comparable rents in the area, all ranging from $19 all the way to, I guess, $26. Looking at the comparables, we have 1881 Ness Avenue, lease start date of February 1st, 2020. The price per square foot at $22.06. We have 2519 Portage Avenue, lease start date of October 16, 2020, with a net square, I can't even talk, at $26.27 per square foot for rent. And then the rest are all in 2019, 2017, and some as old as 2016. I also have another table for C1. That I think that's commercial warehouse. And I have 3 different ones, which is Vermilion, Keewatin, and Jack Blick. These are larger, larger square properties, ranging from $19.75 to $23 a square foot. Looking for more recent leases is fairly difficult. And these are grabbed out in the general market as examples. Page 6 is the overall the workup from the model of all of the units. For this property, we're looking at rental rates ranging from $19 a square foot to $26 a square foot. And you can see there's a vacancy. We have a vacancy loss of 5%, expenses 3%, shortfall $9 a square foot, overall capitalization rate of 6.65%, for a final total of $9,727,000. Page 8, we have a cap rate chart. And if you look at across on retail, neighborhood shopping center, which is posted as NSC, we have listed between 6.35 to 6.95, Colliers 6 to 6.75, CBRE 6.25 to 7, Cushman & Wakefield 5.75 to 6.5. And if we continue on, jump to page 10, you can see pictures, aerial photo, and a street view of the subject property. And then we have from page 11 onwards is the response from the landlord or the property management company. And that concludes my presentation.
I thank you. Mr. Newfield, your presentation, I'm sorry, questions?
Yes, page 5, done by the model.
Yes, done by the model.
Now, you mentioned a sale on page 3. You were aware that that was a multi-role sale?
I was not aware.
Okay. And you also mentioned that it was 3 buildings. Do you know where the dividing line is between the 3 buildings? And I'm just looking at your page. I guess page 9.
Yes.
Well,
Okay.
do you know? Okay, on your page 9, you've got the 3 buildings. One marked 2533. That's the Shoppers, correct? That's one building.
Yep. Yep.
Now, then looking at what's the next building? You know how this thing was set up?
I'm not too sure. It could be that the third building is the liquor mart at 2549. That looks like it's completely attached to the main building of that's 2547 to 2541, or it could be that little back portion. Just looking at how the difference in the roof layout.
Yeah, I mean, you're pretty close. I don't know if you're aware that the Liquor Commission actually, when the buildings were built separately, was 2549, and then took another 10 feet in the 2547 building. And they are different eras. I don't know if you're aware of that. It's an unusual situation.
Yeah, they probably needed for docking or for loading.
Expansion, yes.
Yeah.
And did you review the actual income? You're at model of 718 potential, and it looks like their statements that you provided are indicating 705. It might be a small difference to some people, but I'm just wondering if you noted that.
705 versus 718.
Yeah.
Yeah.
Any reason to not believe that the rents here are arm's length?
Well, what I was more concerned or taking a look at is looking at the triple net triple net rents. When I was reviewing it, I did not take a look at the actuals because given that the accounting done by various by accountants or property management differ. So personally, I was just looking at the rental rate.
But my question then would be, if you look at your page, sorry, let me get to it. Your page 15, that the rents were started or adjusted between first one December 20, October 19, which was then adjusted September 20. Then there's June of 20, and then there's May of 20. So we have a fairly up-to-date set of rents, and they are more up-to-date than your rents on page 4, are they not, which go back to 2017?
Yeah, but these are also long-term. These are all long-term leases, so I'm not too sure if these are these step-up rents that have been negotiated at the start or 10 years ago. So
you're not aware of the lease situation, but that doesn't mean that that they're not, does it? You never asked the question, did you, of the ownership? Did you?
I was not able to.
Okay. And this is called a neighborhood shopping center, and why is it a neighborhood shopping center? And I don't understand these terms. Everybody uses different terms.
Yeah.
What characterizes a neighborhood shopping center?
I guess it's just because there's there's multiple buildings. It has various different types of tenants and amenities, and it has large parking. So it's not just, and it does have it does have one or two anchors tied to the retail. So it's just, you have more than one thing you can do in this property.
Those are my questions. Thanks.
I thank you. Ms. Duncan?
Oh, no questions. Thank you.
I thank you. Mr. Boretsky?
Yeah, just on the actuals on page 13. So what would the actual NOI compare to what you have in the model? I'm a little bit confused with this particular sheet because it has an NOI of 714,980, and then another net income of 495,125. So which one of those reflects what you have, or would compare with what you have for NOI of 646,845?
So
I know that wasn't really part of your presentation, so yeah, but if you could comment on it.
So is it a comment or a question? I'm sorry.
Yeah, I would like to know which figure in the actuals is the one that compares with what you have for NOI. That's my question. On the actuals on page 13.
Oh boy.
I'm trying to get at what the actuals really are, which is, I think, important.
Just give me a moment.
You know what? I think I see it. So I see what it is. So you're okay. You don't need to answer it.
Okay.
It's the interest, mortgage interest. Okay, yeah, I'm good. Further questions?
I thank you. Ms. Ho, I note that the age of the building, and obviously because of the age of 2003, 2006, what sort of renovations took place in this building? Do you know?
I'm not too sure, but it does look like it's more of a newer property, updated property. The facade looks newer. The roof looks newer. I'm assuming they also updated the windows. Aside from that, I'm not too sure what else they have updated. Just a comment back to the net operating income. Normally we don't, like you said, we don't include the mortgage or the interest, but if you look at I wasn't really looking, I didn't look at the very, very bottom. Looking at page 13, there's under actual year to date if you look at the last line, it says 714,980. That's between, and that would, but like I said, it may be including other expenses that we don't include into our analysis. But
Like I said, I can see that.
that would probably be more in line with Mr. Moretsky is looking for.
So, Ms. Ho, you didn't look at any permits that were issued or anything like that, no?
No, I did not.
Okay. And I think there was a sale of the property, but in 2015. But I think Mr. Neufeld had said that it was a multi-role sale. Any information in that regard?
So most likely it was when at one point. So it could be. So if you look at my page 9, looking at the aerial view. So it could be there could be the ownership of that strip. I mean that main building, 2 buildings that amalgamated to 2549 plus the Shoppers. I am not too sure. I don't have the system on hand with me because I'm not on my computer. So it doesn't have my program. And those may have been, those 2 buildings may have been 2 separate parcels and then got merged together.
Okay, I thank you. Mr. Neufeld, your presentation.
Thank you. Sorry, I'm just, there were actually 3 roles in that multi-role sale, including, and I'm just looking at it right now. I've worked for these people for quite some time, and hang on a second. I just want to make sure I get this right. Let me get this wrong. Yes. So they range from 2527 Portage, which is, I believe, Boston Pizza, which is no longer on the roll, plus Shoppers Drug Mart, plus the liquor store building. So it was all 3 buildings. And Boston was then parceled off. There were 3 rolls, and Boston was, and then 2 of the 3 were merged to form this one, and Boston was on its own. I remember this because when they bought it years ago, I was dealing with all 3, and then Boston did their own thing. So it's 4 buildings really, and now we're left with 3. So the issue on page 1. You can see the red dot, and that's the Shoppers at 2533, and then Boston, who was the first one on that sale, is just past the blue line on the right side. The other building, which is 2549, is well, actually, the lot line used to be split at the Liquor Commission's outer wall, but not including the extra space, and I can't remember honestly which of those 2 buildings is the oldest one, and I'm speaking of 2549 and 2547. One is older than the other, and they attached them. One is the 1958 building, and the other was the 2003, and Shoppers was roughly 2004 redevelopment on the site. So when they did the attachment to those 2, if you have a really good picture, but you can see that there's a joint that they added as well. It's a triangular joint to put the 2 together. We have not given you the good detailed pictures that shows it. And then the Liquor Commission occupies 1 piece in each. So for a while, when the roles were separate, we had half a Liquor Commission in each role. The assessor joined the roles and got no complaints there. 2 of the 3 roles anyway. that's just background. There's nothing really on this of concern. It's just you want some clarification. And I don't like when people put forward, I don't like it when sales are put forward and then don't fully explain that there was another property involved. That's a bit, I think, kind of prejudicial. We're using 714,000 as the potential income, and just be clear about something here. Potential income is not the same as net operating income. I don't think that when people make statements like this, that I can't let this pass. Potential income is as full, and that is 705,000 is the actual. Why is it got 714 here? I don't know what the hell's going on here. Well, I'm opening my big stupid mouth here. 718 versus 714, so that's wrong. It's really potential income is as stated in the statements at 705. So there must have been a recovery adjustment prior year that messed that up. So it should be 705, and then after vacancy is placed on there and shortfall and non-recoverables, then you get the net operating income. Now you'll note in this case the vacancy was 5.35%, and that's the same amount I corrected it to in the last building. That's the appropriate one for St. James, and that's right. Non-recoverables, typical 5% allowance. The building is full, but as you have turnover, you have vacancies, and the part of the building that has turned over is the middle section. A lot of turnover in that. Liquor Mart's been there for years, and Shoppers has been there for years. Standard operating practice for most all retail operations is 5-year leases, unless there's a lot of TI involved, and then it goes to 10. Nobody wants to be stuck on a lease for 5 years when the market's changing, because you're missing out on money on increases. And so our office does almost exclusively 5s unless there's TIs, but then we'll do steps in there. And that's just the way things go. And oftentimes it's a 5 and a 5, where there's a 5 plus a mandatory renewal to be negotiated at market rates. So professional managers are pretty good at following the 5-year rule. So generally properties like this are going to see rents on that basis. And it's true that, of course, Liquor Commission has got provincial leases, and Shoppers, I know, was a long-term lease. But that's the standard practice. Other than that, so we have a mistake here on our part. We're $9,000 too high on NOI, so we come up on our potential. So we do come up with a higher NOI than we should have at 612. The assessor's at 646. I'm not going to change it. Just take it into account for the other ways we calculate it with the actuals. 54, 62, 72. And I'm just looking at the difference between our potentials and our NOI, a little bit wider gap in this case. As far as the capitalization rate is concerned, I personally wouldn't be as critical as this. It's got 2 good tenants, 2 good paying incomes. I think the major issues relate to the middle section building age and the way it's connected, and the fact that the center core, you got the 2 anchors, but the center core's got horrible turnover. I would probably suggest 7%, in my opinion. I would go lower, but we made a mistake on income being too high. And I think there should be some balance here, that's all. And so if you don't mind, I would just change that downwards 7% to 8,747,8,747 rather than the 844.5. That's my presentation.
Thank you, Mr. Newfield. This whole questions of Mr. Newfield.
No question.
I thank you, Ms. Duncan.
Just to clarify, so I'm clear, what when you explained the sales piece and the city agreed 4 buildings in 2015 sold for the 10.9.
Right.
It's no longer 4 buildings; it's now 3 buildings that are on the roll together, not 4.
That's correct.
Okay, that's my only question. Thank you.
I thank you, Mr. Boretsky.
Laura, can you repeat what the final value you wanted again, Mr. Newfield?
Sure, 8,747,000, 8,747,000. And in this is a 7% cap on my artificially high income, which would probably be about 6.8% on had I adjusted it correctly. So we're not really that far off on cap. It's just a potential rent issue.
Okay, so you have 612 NOI somewhere around there.
Yeah.
Okay, and on the expenses, income and expenses, page 4.
See, the NOI is incorrect here, our calculation. It would really be about 604 on actual with
Okay, that's fine, yeah.
Yeah, no, that's why I capped it a little bit. I didn't cap it. It would have gone to about 6.8% otherwise.
What I am concerned about, though, is the NOI shown on page 4 is approximately 715,000.
Right, and that's as full. Now, I think that's the. I know what you're
taken off, though, aren't they?
Yeah. Now let me just look at that, because I was looking at the top line at 705, the potential rent, and what I'm looking for is a prior period adjustment. That's usually what happens in these cases, that something came through and was adjusted. And I was looking at, there's exactly where it happened. The property tax refund from the last cycle was, that's exactly it, was a refund of $12,000. There's our missing money. So the statement in this case reflected lower taxes, and then it was actually recovered. So what you're going to see is in the next year statement, there's going to be an adjustment, and it's going to be $12,000 difference there that gets picked up because they have to adjust for it. They have to lower their recovery rate. These statements aren't that difficult to read. This particular operator has a pretty good statement. It's a net building, and we got prior period and post adjustments. That's why I like the 705 line. That's the income, 705,000.
Well, you're not the cities and yours aren't far apart, anyways.
Well, no, I mean, I just want to make clear that we're at 705 and they're at 718. That's how we should have come in at. But then it's the treatment of the expenses as well.
7%. You want 7% cap, correct?
Yeah, but on my corrected income, it's only 6.8. But I didn't correct it. And sometimes I go through these numbers too quickly, because when you do this stuff day in, day out, it's like a second language that's easy to understand. And I know sometimes I go through it a bit too quick at the board.
Oh, okay. I do not have any more questions. Thanks.
I thank you. Summation, either party?
No, thank you.
Yes, briefly. I think that the number we've given you at 8,747,000 is a very fair representation. There was mistakes made, and I'm trying to adjust for them, and I'm trying to be reasonable. It was 7.5 million in the last assessment cycle. That's a significant increase and a good performance during COVID, an excellent performance during COVID. Perhaps it's buoyed by the fact that one of the users is a drugstore, and they probably did a lot of good business, and the liquor store, which did the best business during COVID. And that's just the difference in retail. Here we have one that did actually perform, but not to the tune of what the model's generating. Thank you.
All right. We're going to take about a 10-minute break. So we're going to reconvene at 10:51.
All right.
Thank you.
Madam Secretary, you can shut us down and we'll take 10 minutes. And like I say, 10:51 we'll reconvene. All right. Call the hearing back to order. The next property we're going to deal with is number 125 Scurfield Boulevard. Ms. Ho, whenever you're ready.
Okay. So file number 22-2677, roll number 030651511900, address is 125 Scurfield Boulevard. Property, the assessed value under dispute is $10,159,000 for under the classification of 60 taxable, and the assessed value of $1,493,000. Classification under 40, liability is school taxable school exempt. Based off of a reference date of April 1st, 2021 for the roll year 2023. We have the parcel use code for this property as a neighborhood shopping center. The actual year built varying from 1990 to 2003, effective year built of ranging from 1993 to 2003. We have the overall leasable area of 49,368 square feet. Now, if we move along, jump to my page 4. It is my rent comparable of various rent comparables of properties in the area, ranging from $16.75 all the way to $24 a square foot. And if we take a look at 1585 Keniston Boulevard, Unit J6, that one is leased in June 2020 for $18 a square foot. It's a fairly large unit at 7,146 square feet. We also have 1589 Keniston, lease start December 2019, and renting at $23 a square foot. Now, if we look at my page 5, this is the workup for the neighborhood shopping center. This is for the class 60, and this is all for, and then, so this is for the main building with, along with the with a fast food drive-through, and that overall totals up to $9,410,000. Again, this is all model generated. And then we have an income stream number 2, which is the vehicle car wash. That totals to $749,000. And if you go to my next page 7, we have the income stream 3. This is for specifically valuing the property, the portion of the property that's that's class code 40 with the school code school exempt, valuing and also it's also model driven at 1,493,000. And then you can see my overall income streams and the total on my page 8 for a final total of 11,652,000. And then I'm not going to go through page 9. That's my cap rate chart. And you can see on my page 11 the overall view of the property. Aerial view, you can see there's the main buildings. There's a small building closer to Skirfield that is the fast food drive-in, which is the Dairy Queen. The main strip building on the back, with the restaurants and offices and retail store. And then on the corner part of the property, there's another, and there's 2 other properties more easterly side of the parcel. And then from page 12 and onwards is the income and expense response from the property management. And we also have the COVID questionnaire from the property management. And that is all for my presentation. Thank you.
Thank you, Ms. Ho. Mr. Newfield, questions?
Yes, your pages 5, 6, 7, and 8 these are all model generated?
Correct.
Okay, and you've got breakdowns in your streams. I take it that you have a neighborhood shopping center, car wash, and then a second neighborhood neighborhood shopping center that is school exempt, correct?
Correct.
So now, how many restaurants are on this site?
So we have 1, 2, 3. We have on record 4 different restaurants.
Right. And why wouldn't there be a separate revenue stream for the restaurants?
Because normally what we do is that we try to consolidate as many of the revenue streams into one. The reason why that the car wash is separate and the institutional or the 40 school exempt property is separated is so that the school portion gets its own portioning for taxation purposes.
That's understandable, yeah.
But because the restaurant is part of the main building. So it's not separated.
But there are so many different uses in it. There's 2 units that are medical use. There's office uses. There's in addition to the I'm just wondering why just pick these revenue streams. The Dairy Queen, for example, is freestanding. I'm just wondering with all these multiple revenue streams, you're also going to have multiple applications of vacancy that they're all going to differ, different shortfalls, and different cap rates and different rents, of course. How do you keep it all straight? Like, for example, why would the shortfall for one site be $6 and $9 for the other site?
Like I said, we're trying to consolidate as much as we can into one income stream to simplify the model. I'm assuming. Don't quote me on. Well, I guess you have to quote me on that, but don't quote me on that because I also don't create the model.
Okay.
I'm here to defend it. But the $9 is based off of what our studies for neighborhood shopping centers should be that should be an appropriate. I know appropriate shortfall. $6 would be appropriate for a different property class type. So I'm not too sure where the $6 is coming from. I'm sorry, but at this time, this is. Oh, you mean for the vehicle car wash? Vehicle car wash is for its car wash type, according to the appropriate study. Their appropriate study. It's just vehicle car washes is so different from the other property types that at least with a restaurant or an office or a retail store, it can be changed. But for a car wash, it's so special purpose or special use that you can't really change. You can't exactly change it easily. That's what my assumption is. I hope that answers it. That's not my best answer. I'm sorry.
There's approximately $186,000 in negative revenue for what they call extraordinary events. Obviously, we know what that's for. They give their tenants rebates or rent in order to keep them. Did the model take into account that sort of practice?
For extraordinary events like COVID, we are looking at the property as a long-term investment property, or how for the market they are looking at these properties as long-term investments. So COVID is more or less like a one-off. So I'm assuming that they're not going to be taking consideration of COVID happening again, or else that would probably affect the overall market again. So the short answer, I don't think that we should be taking probably shouldn't be taking consideration for COVID because it's just a one-time thing that happened in comparison. We're looking in a span of 10 years as a property with a market revenue stream.
How do you reconcile that with the fact that the government, the legislature, determined we would have 2-year periods in which to do a reassessment? Why is it appropriate to have a long-term view when the legislation says take a 2-year view?
Because the 2-year view is for reassessing to market value, but in order to assess in order for market to be valuing a property, and a potential investor is looking at the long-term holding of a property. They're not looking for more than 2 years. They're looking definitely for more than 2 years.
What about repayment to government of these various assistance?
I'm not too sure.
You don't know about that. Okay.
No.
And let me just see. So when you ended up with your capitalization rate, this was then a blended rate of 6.78. Was that a weighted blended rate?
Oh, the 6.75?
6.78. That's a blended rate, but is that weighted or averaged?
Oh, I'm assuming that one's probably average. This is just. Give me a second. I'm not too sure.
It looks weighted to me. That's all. I just wanted to clarify that point.
Okay.
Okay. Those are my questions. Thanks.
Thank you, Ms. Duncan.
No questions. Thank you.
Thank you, Mr. Boretsky.
Yes. I have one question. Page 14 of the reported income and expenses from the client. On your presentation, net income loss approximately 654,000. So of those, you would not allow mortgage interest, correct? 150,000 approximately.
No,
Is that the only expense you wouldn't allow on here?
we don't include leasing commissions and tenant improvements. We have a municipal board order that indicated that we don't use those. We don't include those for operating for non-recoverable operating expenses. And if this is a true triple net property, the property taxes and a good portion of the administration and insurance and security and site maintenance is actually and building like maintenance is recovered by the tenants. And same with the utilities.
Yeah, with this line adjusted, or sorry, net income loss is going to be.
If it's lost,
What
it will
the
be.
company has. Sorry, can I finish my question?
Yep, sir.
So this net income line is the amount that the owner has made in his for that year, correct?
Yes.
All in.
Correct. Yes.
So if you were to not include those mortgage interest and leasing commissions, then the net income actually is somewhere around 800, over 800,000 then, correct?
Correct.
How does that compare with your model limit? You're at 790. Okay. So that's, if I was comparing the apples to apples, I'd be using that 800 plus thousand compared to your 790,000. Accurate?
I'm guessing so.
Yeah, I do that often too as well.
I'm just like,
I guess I'm just trying to point out the comparison between the actual and what you have in the model, and it seems to be in line. So, because these actual expenses would include all of them, right? The exempt, the non-exempt, and the car wash on the actual report, right?
I think so.
Yeah. Okay.
Okay, thank you.
No further questions.
Thank you. I just have a couple questions, Ms. Ho.
Oh, boy. Just kidding.
You have 3 income streams,
Yes.
and I've totaled the numbers and the square foot that exists there. Both you and the applicant agree in regards to that. But my question stems to the class 40, the exemption, school exemption. Now you have 6,400 square feet, and you've got to a value of 1,493,000. So what makes up the 6,400 square feet?
So there is a I believe a Montessori or nursery, and that's what and they applied for a school exemption for the realty taxes.
So is that the total 6,400 square feet?
Yep.
That's the exemption.
It's just the one property. It's the one premise. Yeah.
Okay. 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 That's all the questions I have. Thank you very kindly. Mr. Newfield, your presentation?
Follow-up question.
Yep.
Ms. Moretsky asked a question where he surmised that the net income was $800,000. Just ask the assessor, how much was the government grant to this site?
So it looks like abatement extraordinary events. Nope, that's
$112,243. Do you see that? Line item
I'm looking for it.
357000.
Sorry, can you repeat that again? Income from a government grant, 112. Yep, $112,243.
So taking that $112,000 off the income, what would the actuals be then? Do you know? Just roughly 690,000.
Yes, I believe so. But you also will be taking out. You also are getting rent abatement. There's also the rent abatement too. So if you take away the grant, you also should be taking out the rent abatement.
You don't think that the losses happened? They're artificial? Okay, those are my only questions.
Thank you.
Mr. Newfield, your presentation?
Yeah, thank you. I'm fairly familiar with this mall. I go there every Saturday to buy my wine. It's a bit of the history of it. It's got a strip plus 3 pad sites, a restaurant, a car wash, and a Dairy Queen. And in the strip, there's a variety of users. Now, actually, there's an interesting thing I just found out about because I was working with one of the owner and the tenants, and they want to reconfigure their space. If you look at the pictures, the strip has 3 distinct sections and with 2 load-bearing walls in between. So unlike a traditional CRU, where you would have demising malls would be movable, these are not movable. So right now there's a real need for one user to expand and another user to move somewhere else. This isn't going to happen cheaply. So it is a downside on this because of the age that it was built and the manner it was built. It was also built in a part of town, Scurfield Boulevard, which is at the time it was built was mostly industrial, but it is not Caniston property. It is not Waverly property. It is off that. It's Scurfield. It's a rearage mall. It's a neighborhood service center. No real national big brands there. It exists to sell wine to people like me. I'll get my hair cut there. And the kids used to take music lessons there. And we wash our car there. I mean, we're not talking about big anchors. Like, for example, the last mall we looked at, which had the anchor of a Shoppers Drug Mart and a liquor commission, because this is not on a primary route. Building right behind it is Lowe's that was built in on the land in the front. The income, you can see that we really don't have much difference in the income. And part of the reasoning for this is that the method of calculating it is quite hypothetical. All of these tenants got rent abatements during COVID. I know. I interviewed them all one by one. The owner was great with it. He did what he could. He got some money back. And it was the impact of this, the way to look at this, look at the rent abatement versus the costs. I think I threw a number out there of $186,000. It's actually, I redid it, $189,000 that they gave in abatements. They collected $112 back from the government. $77,000 loss. That's the way to look at this. Now that loss, we don't ignore it. That's what's called a non-recoverable. Big year, 77,000. That's why it's there. That's why we have 5% allowance. That's well over 5%. And that's the silliness about this. We have someone who's done this and incurred the big expense, and the model, the assessor, I'm not saying this particular assessor, but the way their system works is COVID never happened. It was just a blip in time, and we can forget all about it. We're going to take a long range view. Fine, take a long range view. Put in 5% recoverables to compensate for these losses that happen every so often, like a locust that happens every 7 years. We have a problem every 7 years. And that's what makes me mad about this assessment. And I am mad. This is wrong. This is immoral. We can't take away the non-recoverables and say they don't exist and then say COVID didn't exist. You got to deal with it somehow. This is how you balance it off, non-recoverables. And so that's our second big difference. No, our first big difference. And then lastly, the cap rate. On the cap rate side, the downside of this mall is there's a couple of issues that I was concerned about. One is I was telling you about the multiple buildings, so it's extremely hard to redemise. Typically, you'll have a steel framed wall and maybe double drywall in between each CRU, and then you can move that and reconfigure as required. Can't do it here because it was built in 3 sections with masonry demising walls, bearing walls. So that is a bit difficult. The second is the location. This was built at a time when only White Ridge existed for potentially to service. Since then, there have been more residential development happening in the area, and it is finally coming into its maturity. And it has only taken 30 years for that to happen. It was too quick. Retail always follows residential. It doesn't lead residential. And so it's a slow maturing mall. But while it was maturing, what you see is a overzealousness to fill it up, to do anything just to get it full. Now, the biggest problem with this mall is the poor configuration and the poor traffic. I'll just tell you, there's an anecdotally how bad this is. I want to go over buy something at the grocery store at 1:00 on a Saturday afternoon. I can't even move in this mall because the dance studio is going, and there's like 50 parents who are sitting outside in their cars and hogging all the stalls because they can't leave their kids alone for an hour just to take a dance lesson. Yeah, I'm a little old man cranky about that. But the point is, just get back to the real problem. It's just overuse at certain times, and the car wash is that perpetual lineup out the drive and blocking the street where there's 12 cars lining up, and because that's a car wash. So there's some bad design issues here, and I know the other tenants in the mall really don't care for the dance studio and the way they strangle them during the hours that they're doing business. And it is a down factor on design. So that's probably why 7% we put on it isn't a bad number. It's just at the higher end of the range, and our caps, which are derived not through modeling but through sales and analysis and professionals, like the 15 agents who are next door to me, who sell these properties and know what the caps are and know what the market's going to do. Professionals, experts, not modelers, have said that our cap rate for retail is, for something like this, between 6 and 6.75. Now, the 6.75, of course, there's some methods of calculation. The ceiling is actually is 6.25 to 7 based on, we have a different style of calculation because we deal with the purchaser's cap, not the vendor's cap. But it just puts the top of our range for a good product at 7%. So this is not a bad product. It's not inferior like some of the ones we've heard today. It's not like the one on Portage Avenue or that sort of a basket case. It's good, but it's going to cap between and in the high end of our range, which is 7%. With its difficulties, it's off the beaten path. It is not on Kenniston. Flip it around to another street, and you're going to get a half-point gain in the cap. And that's my presentation. Thank you. And sorry for the ranting.
Thank you, Mr. Nuffield. Ms. Ho, questions?
Or no question.
I thank you. Ms. Duncan?
No questions, thank you.
Thank you. Mr. Moretsky?
For your final value, you're asking for 10,938,000, correct?
Sorry, I have to go back. Yes, you're correct.
How would you want that broken down with the exempt portion?
Right. I was looking at the rents and they all seem to be fairly homogeneous. So I think that the same ratio that the assessor has, which is 12.8%.
12.8 for the exempt portion?
Yeah. So that's going to be 1,402,000 school exempt.
402,000.
And
Is
9,536 for taxable.
536 taxable. Yeah, that adds up, correct. Okay, I think that's the only question I had.
I just have one question, Mr. Nofield. I questioned the assessor in regards to 6,400 square feet. She had said nursery. I'm looking at your presentation and I don't see any nursery here.
No, it's sorry, I'm eating. It's Shelley Shearer Dance School, and it falls under the Act section, 22 of the Municipal Assessment Act as a seminary of learning. Myself and Mr. Mercury were the ones who went and requested it, and the city was obliging.
So the 6,400 square feet, and you have car wash, DQ,
right.
Restaurant, strip. Is it in the strip then?
Yes, it is. It's you know where my picture, the red dot, it's almost right there.
Okay. And like you say, the it's 12.8 for the exempt, and it's the 87.2 for the taxable, eh?
Yes, that's correct.
Okay. Summation, either party?
I will.
Okay.
So I was apologize if sometimes I'm a little emotional, but this bothers me. We manage this property. I know the owners quite well. I know all the tenants, and it's not because I want to be their friend or wanted anything favorable to them. I just know the building. I don't do a model. We knew what happened to this mall in COVID. We knew that the owner reduced rents, everything he could to get people to stay. And in addition, some of the tenants got rent abatements from the government too. And the difficulty is after the fact is how do you deal with that evaluation? Is this income or is this like an insurance claim, which doesn't go into income? So the way to get around this question is simple. We'll use the face rates, which were never collected, by the way, and we'll treat the loss on the credits versus the abatements as a non-recoverable to be factored into the weight properly. So I didn't ask for $77,000 non-recoverable. We asked for $26,000, and if you look at their sheet, their statement that they provided you, they actually had $26,000 in this year, because of tenant turnover. Those are non-recoverables plus the 77. They're at $102,000 for the year, the government grants. Some of these are going to be repayable. We have to be repaid. We don't know yet. They're coming back and clawing them. So, but those are uncertainties. I think what we're requesting is an extremely fair number. Thank you.
Thank you. Let's press on to the next property that we have is 263 Kennedy Street. Mr. Newfield, look at your presentation, and I'm sure you're probably going to adjust it. So we will first hear from the assessor. Ms. Ho, take us through this property.
Alrighty. So file number 22-2404, looking at roll number 12093623000, address 263 Kennedy Street. The assessed value under dispute is $3,298,000 for the reference date of April 1st, 2021 for the roll year of 2023. We have the parcel use of CMRST, a store. The actual year built is 1922. The effective year built is 1937. We have the zoning under multi-use. The overall leasable area is 22,516 square feet. If we jump along, there's a subject sale history of March 1st, 2017. Sworn consideration and sale price of 2.4 mil. We jump along to, and just letting you know, I'm not too sure too much about the history of the sale. I'm just pointing it out. If we jump along to page 4, we have a lovely rent comparable chart of rents in roughly in the downtown area that varies from all over from $15 a square foot or $14 a square foot to $27 a square foot. If we look at my page 5, this is all model generated for the income workup. The vacancy losses generated by the model. Expenses, overall capitalization rate is all generated by the model. Same with the rental rates. And then we have the cap rate chart on page 7. We jump along again to page 9. You can see the aerial view of the building. And then we have the street view of the building at various angles. From page 11 onwards, we have the response from the property owner or property management. And that's all for my presentation for today.
Thank you. Mr. Newfield, questions?
Yes, certainly. Page 5 and 6, valuation, was this all done by the
My
model?
model, yep.
Okay. And you're using 22,516, and I just want to ask you if you looked at what the property manager put on your page 12.
Yep. It's the discrepancy is it's also including the substandard basement into the overall lease, so the leasable area. So there's 2,800 square feet added on. So it should be close. It would, if you take away the substandard basement. 2256 minus 2,200, it'll be 19,716.
Still a variance from the property manager's number was 16,845, correct? Another 3,000 feet somewhere.
Yeah.
And
I'm not too sure where it could be. They could be not including the exterior wall. It is an older building. Facade.
Seems like a relatively large difference.
Yeah.
And do you have any reason not to believe the property manager?
Not that it could be just. I would prefer to do a further review. I did not realize about the large area discrepancy.
All right. Now, on what they've also told you in terms of vacancy, and that's on page 12 again. Confirm there is only one tenant in there at 3,800 square feet, correct?
Correct.
And that tenant appears to be paying $13 a foot, correct?
Correct.
So which is that PID number 21046?
Most likely, or it could be.
Well, they're both 3870. That's why I was picking on it.
Yeah.
So they're paying 13, and the model has them at 16, correct?
Correct.
Now you talked about the sale. Who's the vendor? Do you know?
No, I do not know.
Now, okay. You would agree probably that that statement looks pretty bleak, does it not?
Yes, it is very bleak.
Okay.
I did try to reach out to find out more about this property. However, it seems we are both very busy.
Yeah. Yeah. Now, and its age being 1922. How did it get to 1937? Do you know?
Someone reviewed it, gave it some effective year build, just because there was there may have been some updates.
Do you know whether or not it's on the historical designation list?
I do not know.
Okay. Those are my questions.
Sorry.
Oh, sorry.
Ms. Duncan? Sorry.
No questions, thank you.
I thank you. Bill, questions?
Yes, page 11 of the income statement provided by the client.
Yes.
There's actual for 2020, a loss of 45,205, correct? Net income loss.
I believe so. Yes.
And your model is showing a net income of 270,000.
Yes.
So is it still your opinion that this property has the potential to have a net operating income of 270,000 when the current tenant is only has lost 45,000 in 2020?
That's because its overall is mostly vacant, so it's not attaining.
Mostly what?
More,
Sorry.
It's most. So this is as if it was is 100% rented, right? At this moment, the actuals is because it's only down to one tenant. So if there was more tenants, it would be getting more revenue, and its actual wouldn't be at a net loss.
So you don't know why this particular owner decided not to rent out those units?
It may be having a hard time. I'm not too sure the exact situation for this property. The property owner may have a hard time attracting tenants, or they're not making an effort to attract tenants. I'm not too sure.
Okay. Don't know the reason why though. Okay.
No.
Further questions?
Thanks, Bill. Mr. Newfield, your presentation.
1 second here. Okay. See, now you don't know my mind. I'm not going to change this number. This is a rather, there's some unusual circumstances. That's why we're here at hearing. The purchase in 2017, the vendor was Marvel School on the second floor. They left after the sale, a few years after the sale, and they have been unable to find any tenants. It's professionally managed by Martin Eagleton, and I've known the people at Martin Eagleton for over 30 years. They manage a couple of the other properties we've seen today. They do a good job, and all they got left is Don's photo, because you know what? Nobody wants to be on Portage Avenue at that point. The concept today, and I spoke to the owners in May last year, was they're thinking of a residential conversion. They haven't been able to attract any tenants. Don's is leaving at the end of their term because, you know, people aren't buying cameras anymore and developing film. So that one should be vacated. Just trying to look at when they say it's vacated. September of 22. I haven't checked if they're still there, but the notice had been given. I would look at this as a project building and not a planned project building. You know, for example, like Medical Arts, 325 Broadway, they were planned to be converted after purchase. This one is not. This one was hoped to be a revenue producing building with Marvel in it, with Don's in there, and for some time. So my take on this is I would look at this income and say, that's interesting. This is $50 a foot. And most loft buildings, conversion buildings, are trading anywhere from $10 to $30 a foot as project buildings where they need a lot of work. At 50 with the location on Portage Avenue, possibly the 50 seems fair. It's, you know, you can see that how badly skewed the numbers are. The model has got the wrong area. It's giving $16, $18 rents for something that $19 rents for something that got one tenant paying $13, and this huge vacancy. I don't have another way to value it. I personally would have gone on direct comparison on this and looked for shell buildings and where people bought them for another use. And we had some properties for CMOFF on page 38. We had a couple, and I was just trying to look through any of these to see if any of these were project buildings. And I note that 323 Portage is, and the sale, I was just, it showed up as $1, but the number was 625,000 on sworn value for 40,000 square feet. So $15 a foot. That's a project building. That's the old Dayton building, virtually across the street from the subject. And that would be a good comp right there at $15 a foot. Like I said, we didn't spend a lot of time on working these up, and the person who did this just looked at an income-based approach. It would have been, as I said, better. This should have been a sales comparison approach. But it compares well to other ones. And the other building I was just thinking of was the Medical Arts building, and I can't for the life of me remember how much that sold for per square foot. Obviously, I can't enter it as evidence, which was a massive conversion building, and not the first sale when government bought it, but the second sale when they had to dump it. Or the Bay, which is a block away, which I guess everyone figures is, one appraiser in Toronto said it was worth $0, and the owners gave it away for a charitable receipt. You know what? I apologize. This is the best I got right now, but I think that the number as a shell building is reasonable. The sale is irrelevant. They bought it with the basis that someone was going to stay on and pay them rent. Didn't happen. They left right away. Obviously, and I can say that the owners are a little bit unsophisticated in these matters. I would think that someone would have given them advice to say, if you're buying from a vendor, better get a long-term lease on them before you buy the building. Don't trust anyone. And not to say that these people do it deliberately, but that's how you should be doing business. So there was a mistake made. Certainly not worth anything more than that. Now, another way of looking at this is land. It's 11,000 square feet. The other day we were in hearing, and I think most of the numbers for downtown land came in about $85 a foot. So $85 a foot on 11,296 is 960,000 less demolition. 823 is a pretty fair number on land value. So I would have brought it in land value and project building value. And I'm giving you verbal, but I'm really, I know that this is the appropriate way. Sorry, I can't say any more than that. I could say, thank you. That's really, I'm gonna, that's my presentation.
Sorry. Ms. Ho, thank you, Mr. Newfield. Ms. Ho, questions of Mr. Newfield?
I'm just curious. So when you said it was probably going to be converted for residential use, is it going to be like for apartments or for condos?
I don't think the owner has firmed it up yet. I mean, we had this discussion with him about what their planned use was, and that's what they're looking at. They don't have the money to do it right now, but that's kind of what they're leaning towards.
All right, that's all. Thank you.
Thank you. Ms. Duncan?
Do you know who the tenants were in 2017 when they purchased that building?
Yeah, Dawn's was on the main, and Marvel School of Beauty was on all the upper levels, and then there were a couple of small retail units that came and went. I'm just going to quickly look at it just on a street view. I remember some of them. I think there was like maybe a bridal shop or something. Marvel School had the rear section as well as the upper level, and then Dawn's was on the on the first floor portage frontage, and Marvel also had the space next to Dawn. So Marvel had all the space, so all the units that are shown on the assessor's page 12 that are now vacant, they were all Marvel School of Beauty.
Did you say Marvel School of Beauty was the owner, or that was just that's the current owner?
No. The current owner is some Marvel sold to the current owner and then vacated some short period later. They were not aware Marvel intended to vacate.
Okay, no other questions. Thank you.
Thank you. Bill, questions?
So how long have those other suites been empty besides Dawn's? Are you aware of that, Mr. Newton?
I don't have the exact date. I only met these people in 2021. I can see from the statement that obviously from 2020 they were vacant. There you go. Since October 17th. It's October 31st, 2017. There on that rent roll, it says that. So that's 6 months after the sale.
Okay, just looking again at the two presentations here. You have the city is valuing approximately $3.3 million for this property. You have $823,000, 25% what the city has. Don't think I've ever seen that wide discrepancy before. So somebody is way up. So could you summarize briefly why you think your 823,000 is accurate?
Well, you have a usage. Marvel has been there for decades, and they were the owner operator, and they operated. There was a dance studio up there of some sort, and as a matter of fact, they shot a movie there. A Richard Gere movie was shot on the second floor. It was a usage that's obsolete. They sold the building and left. Don's is a usage that's obsolete. So now the problem is to backfill on Portage Avenue. Nobody's backfilling on Portage Avenue. There's no regeneration of North Portage, South Portage in that region. Where it's happening is brand new developments like True North. Sure, and Hydro, they're only a couple blocks away. But they got accomplished by bulldozing the old sites and rebuilding something. So these older North Portage sites, that's what they sell for. And I'm racking my brains and I'm thinking about other project buildings that sold. And that you buy one of these, you're either going to completely renovate it and change its use, or you're going to demolish it for its land value, because that's what's happening on Portage Avenue. And of course, while we're talking here, I'm going through my mental inventory of buildings that have sold on Portage Avenue. And for example, the Avenue building, $10. That was, I don't know, 80,000 square feet. But everybody knew that was a basket case. I found the medical arts sale, which was an obsolete medical use converted to multifamily. That went for $66 a foot. I mentioned 323 Portage, and that went for $15 a foot. I'm looking at a couple of other properties here. I was thinking of the one at the corner of Smith and Portage. One of my clients bought that building, and I'm trying to remember the stupid address of it. They redeveloped that building. I think I got the right place. Ground floor, 5590. Yeah, that's right. 8 floors. So 25,000 feet. That one went for $100 a foot. The Sterling building, I think it was called. So that was the high water mark. The one next door, where I think I got this right. Tipsy Cow, 5,000 feet for $300,000. That's another $60 a foot sale. These are all obsolete buildings, and I would expect it to be in that range, $15 to $100. So we have it at 50. I'm not saying it couldn't be higher than that. We haven't done the analysis on it, and I don't want to offer you a firm opinion, but you know, $15 to $100 a square foot on 16,845 square feet is half of what it's assessed at.
So that 16,845 square foot, is that the actual building leasable area if it was totally leased? Or
Yeah, yes, it is. I suspect that the assessment has probably got some basement space in there, which is not rentable. All these old buildings on Portage Avenue have basements. I remember one of my first jobs, I was a janitor and having to clean the waters out of a basement that had flooded. It's not leasable space, it's accessory space. Never counts in the sale value. But I think that's what it is.
All right. No further questions.
Mr. Chair, I got a couple more, sorry.
Go ahead.
Okay, so just a little bit more about the current owner. Rocky, do you know what, do they have other holdings? Like, are they a bigger business entity? Or are they just John Doe from down the street that paid $2.4 million for a property that they didn't really know what they were buying or the implications of leases and all that? Like, what kind of owner are they?
Extremely unsophisticated.
Do they own other buildings?
No. They're refugees.
Okay. But they paid $2.4 million in 2017.
Yeah, and the person leading it, and I met with him and his new advisor, and they're learning as they go. They do not fall in that category of knowledgeable buyer. And I don't want to be rude or mean about it, but they never sought professional assistance, and so they brought another person into their organization. It was a group of families, and he started leading them towards, let's do this thing. We're going to have to change the use. We're probably going to have to reinvest. First thing, let's get a proper property manager. They hired Pam and Sandy, who I know at Martin Eagleton, and their office is actually next door. And they said just to look after the property, to collect what little rents we have, and manage it. So they're learning. I'm trying to be so politically correct here. Let's just say where they came from, there was they never learned anything like this.
Okay, and then just my other one was just in regards to the rent comparables that was in your evidence. That's just a standard chart. You weren't really utilizing it as part of your valuation. Like you said, you're having some challenges based on whether it be land or property versus an actual rentable space. Is that?
Yeah, I didn't do this workup, and you probably hear so much of me how I change things when I look at them. I'm not actually disagreeing with the final number. I would just have characterized it as a project building and ignored any sort of income-based approach. And I mentioned I verbally have given you 5 sales between $15 and $100 a square foot. It would be in there, in that range somewhere. And that's upper level space, because we don't count basement space on sales. So I mean, it could be anywhere from $225,000 to $1.6 million, and that would depend on the utility, the future utility. Like the one that went at the high end at $100 a foot was already set up with each floor having mechanical, and it had the elevator already. Now this one is not set up like that, so there'd be some demising costs. There would be changing the plumbing stacks and coring through and doing all that. It reminds me of the medical arts project.
Yeah, you mentioned that, Rocky. So I don't mean to cut you off, because you presented that information fine earlier on. That's more of a verbal evidence than like verbal presentation.
Yeah, absolutely. Yes, you're correct.
No, that's great. Thank you.
I thank you. Summation either party?
No.
Okay.
I apologize for the presentation, and I don't. We're under time constraints too, and because I'm an accredited appraiser, I can't come out and give you value without doing my own appraisal. I've given you a range of properties that have sold that are similar style in this, and would suggest that anywhere in that range would be something we could live with. It is a bad building economically. Thank you.
I thank you. Let's go to the last property that we have, which is just down the street to 247 Kennedy Street. So, Ms. Ho, whenever you're ready.
Sounds good. Number 22-3065, roll number 12093629000. Address is 247 Kennedy Street. Assessed value is $1,351,000. Reference date of April 1st, 2021 for the roll year of 2023. This is assessed as a commercial store. Actual year built is 1929. Effective year built is 1958. We have the overall leasable area as 6,842 square feet. If you jump to my page 3, there's a sale, subject sale history of on December 24th, 2014 for consideration and sworn value and sale price of $2,950,000. If we continue on to my page 4, we have a various we have a rent comparable chart ranging from $24 to $27. These are smaller units. Just to make a note, we have a model-driven income workup on page 5. So vacancy, expenses, shortfall, overall capitalization rate is all derived by the model. And skipping page 7, which is the cap rate chart. If you look at my page 9, you can see pictures of the subject property with the subway. And then from page 10 onwards is the response from the property management. And that's my presentation for now.
I thank you, Mr. Newfield.
Page whatever. This is all done by the model, right?
Yes.
And so the model's saying approximately 115,000 in income.
Yes.
Classed as retail.
Yes.
Okay. And in this case, on their rent roll, I just want to double check this.
Mm-hmm.
Oh, they don't say it. So you've got basement space in there.
Yep.
The rent roll doesn't show basement rent, does it?
Nope.
But you've got what, $2 a foot on it?
Yes.
$213. Okay. And for a building built in 1929, you've got the model's assigned a cap rate of 7.55. Now, what was done to the building that would make anyone change the effective age?
Generally, any major renovations but I'm not too sure what permits were done.
Okay. And did you review the income and expense statement? Page
Nope, I did not.
10? Okay. It looks to me like they're saying approximately 99,000 in potential income, so it's a bit different than what you have.
Yep.
Okay. Oh, yeah, sale. That was my last question. You were aware that it was a multi-role sale?
No, I was not aware.
Are you aware of the marital estate issue that was part of this sale?
It was mentioned when I reached out, but it sounded, but not too much was gone into it.
Okay, those are my questions. Thanks.
I thank you. Ms. Duncan?
Yeah, what do you think, like what's happening in those two basement areas, where the 473 and 474 square foot was issued by the model? Like is, based on previous presentation, it doesn't sound like there's terrific usage in those basements downtown. What would it be rented? What's the purpose in those areas?
It would most likely be used as storage. There are some cases where I've seen the basements that have been used for office use. There have been restaurants, but they would be labeled or tracked not as substandard basement. They would be actually tracked as leasable basement, which are actually like finished with drywall, ceiling, tile, and flooring. I haven't gone into this property, so I'm not too sure. So it most likely it's most likely being used for storage for the various tenants.
Right, but you don't know for sure what's going on down there. Obviously, it's not leased.
Earlier last year, I did request for an inspection for this property to at least verify the use and the overall square footage of this property.
So it was inspected then, or?
Was not inspected. It was requested by me, but has not been done.
Okay, because the owners wouldn't let you, or just time constraint on your end?
No, it's just we have to go through the agent in order to do inspections, and we have not been able to arrange a time to inspect the property together.
Okay, thank you. No other questions.
I thank you. Bill, questions?
Yeah, page 10 on the customers mail-in, not customer, clients mail-in.
Mm-hmm.
The total leasable area, let me try that again. Total leasable area they have listed is 3,900.
Yep.
You have 6,842. Can you explain that discrepancy? Or what you might think that discrepancy is due to?
Mr. Boretsky, maybe we'll let Mr. Newfield answer that because that's part of his presentation.
Oh, it's in her presentation though. Okay.
Anything further, Bill?
No.
Okay. Mr. Newfield, your presentation?
Yes, thanks. Yeah, I was just looking at it. I know what one of the issues is that the assessors on the square footage they put in the basement. And, in this case, I'm not disputing the basement as a storage rent because I know that it's used for storage. When I worked at Stevenson, our records were in the basement there. So we know they were getting rent. The difference would be 4842 of the other area versus 3,900 as indicated by, I see there's more substandard basement in there. That's what it is. So they've got 2,870 feet of basement. It still doesn't add up to the rent roll. And I imagine it's just leasable area versus gross area. The rent rolls page 3, 1239, 1301, 840, and 520. Okay, no, that's about right. So it's the basement area. We're not even going to bother with the basement area because I know that the income is included in the actuals. It's not rentable. A basement, when it's garnering income, is deemed a contribution to overhead. Because if you try to do a net on it, you usually find that they fall below the operating costs. it's just additional income. It's like having a cell tower on your top of your roof. You don't take and allocate a degree of the expenses to it. It's just extra income. So the statement, and again, this is managed by the same group that does the last one we heard and another one today, Martin Eagleton, and they fill these forms out. They know what they're doing. When you do the math here, the net income is $98,311, not $115,000. Vacancy, we looked at retail and then downtown and took the average. And of course, downtown has bad retail vacancy. I mean, we know because there's 12,000 square feet next door vacant. And that's a reasonable amount. And then non-recoverables exist in this building. Shortfall was calculated on, as I said before, the taxes on this are very high, $8.32 a square foot, based on the 3,900 rentable. So that shortfalls are actual. And those are big differences on the income. All the categories. Our NOI is 81,000 versus the city at 101,000. So it's a $20,000 NOI difference. Our cap is 825, assessor 755. We both recognize that it's a higher cap than typical retail. I think a user would look at it and say, a Subway, that's pretty good because you are picking up business from the downtown. It's been there for quite some time. Some of the other uses, though, are they're small spaces and subject to turnover issues. The age is 1929. Yeah, it had a new facade put on it at some point, some brand new siding. That doesn't make it younger. They didn't replace the frame or the foundation or anything like that. They had new siding put up. Doesn't change the age. Quality and condition is, around average. I think the major issue on this is the costs have always been high. If you look at the $11 a foot for operating costs, that's pretty high because your tenants pay gross, landlords want net. It's going to put downward pressure on that, and the rents are at their peak. They're not going to get any better. Capitalization is about anticipation of improving your rents down the road. This isn't going to improve over the road. Last thing I do want to say is it was a multi-role sale. Anybody who knows the circumstances of the transfer, and I don't like to talk, I want to be careful what I say about the transfer. It was part of a marital estate splitting of assets. And there's no way in the world that is a market transaction. It is not about the definition of market value. And I think our number is pretty good, 983,000 for this. It's a good producer for a little site in this neighborhood, performing much better than the building next door. And it's probably just a difference of a half a block and the ability to attract the food service operation. Incidentally, 263 cannot attract a food service operation because you have to have the hoods and the equipment. And you can see on our page 1 that the subject site has got the hoods installed already. It's a pretty good number, and using actual rents. That's my presentation.
Mr. Chairperson, you're muted.
Thank you.
No question.
Okay, I thank you. Ms. Duncan?
Is it fully occupied?
Yeah, it's generally had a really good occupancy history. This building, I've worked for them since 2003, and this building is always had like a little tenant all the time, whether it be a nail salon or a sandwich shop.
Okay, and so the 7.5% vacancy isn't necessarily an actual then?
No, it's a market based and it's skewed higher for its location. It hasn't proven that badly in its lifespan. I agree with you. It's kind of towards the upper end of the proven performance. One could potentially look at its history and suggest that it's never performed that badly and go a bit lower on it. I wouldn't disagree with that.
Okay, no other questions. Thank you.
I thank you. Mr. Moretsky?
I do not have any questions. Thank you.
All right. Either party want summation?
No, thank you.
Mr. Newfield?
Yeah, I've just quickly addressed all of them today, and with the exception of the one property, which is a basket case, we're looking for paid rents. And I don't think there's any better evidence in this world than the paid rents. We've had very minor differences in the cap rate. The only one where there's a major issue was the one with the environmental registration. I think we're spot on with the numbers. And if there's anything that we can know about the market is, first of all, the government says reassess every 2 years. Don't ignore what happened in COVID. Everyone's going to take a hit in value, especially retail. One of the hardest hit facets of real estate, office and retail. You want to know where to go is chase the actual income, not a model. Thank you. That's we're going to be pretty stubborn on this chase the income thing. The actuals.
Thank you, Mr. Newfield. I think that concludes your part here. So thank you for your presentations and results very soon. So have a pleasant day. Ms. Ho, thank you very kindly for your presentations, and that concludes your part. So we have heard all the items scheduled, and this hearing is now adjourned. So thank you both for your presentations, and bye-bye.
Bye.
Thank
Have
you.
a good day. Bye.